Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. It's the start of the second quarter here, and North American equity markets are certainly under pressure. No surprise. Despite ongoing headwinds, our next guest is keeping a close eye on emerging opportunities as the landscape continues to evolve. And this is a little bit around the world. With volatility in focus, where should investors be looking for resilience? And how can advisors help clients stay the course in uncertain times? Happy today to be joined by Portfolio Manager Patrice Quirion to unpack all of this and more. Patrice manages several Fidelity funds, including Fidelity International Concentrated Fund and Fidelity Global Fund. Welcome. Great to see you again.
Pleasure to be here.
Great to have you here at this very moment because you're going to help us look around the world a little bit. There's some nervousness in markets. I mean, everyone's feeling this way. We're all a bit glued to the screen. How are you feeling about it? Is there any sort of lighter pieces that you can point out?
Yeah, so obviously this is not the ideal backdrop for any investor, but I have to say on my side, I do welcome this change that's taking place. And I think there's a couple changes taking place. One is an economy that is clearly going to take a hit from that geopolitical tariff uncertainty.
You're talking about Canada.
Canada, but I think it's going to be felt across the globe, realistically. And I think we're starting to see evidence that this is starting to bite over the past few weeks, month. So this is not ideal for markets overall, but as a contrarian investor from a market that, in my opinion, was getting maybe stretched, getting fewer and fewer good long-term opportunities that were found. We always say volatility is what creates opportunity. So on one side, I'm not saying we need to jump in at this moment. I think that could take some while to digest, like a pretty big period of uncertainty, potential pause in consumer confidence, corporate confidence, etc. But this is the kind of environment you want to be on your toes and look for opportunities, as this is when they'll be created. The other thing that makes me, to some degree, welcome this environment is this is all happening at a time where we could very well be in the early stage of a bit of a fundamental change in market leadership. And this is, I'm not talking about something that will last like a few weeks. I'm talking about something that lasts like a few years at least, where it's no surprise to everyone that the story of the past 10, 12 years has been US, especially large cap, especially tech sector, really like driving markets globally. And you can look back historically, and more or less every decade has its own leadership. And it is fairly rare, historically at least, that what has been driving the market for the past 10 years remains what as the leadership for the next 10. And I think we're maybe at that point where, from a combination of maybe the US starting from a very elevated starting point and now bringing question on sustainability of like the consumer spending patterns, maybe bringing some question marks around tech spending, notably around AI, data centers and all of that. And obviously like the geopolitical backdrop is not going to be positive for anyone, certainly not us here in Canada or in Mexico or in Europe or China, but two things to keep in mind. If we are at a starting point where the US was doing extremely well and potentially slowing down, you look at Europe, you look at Asia and China specifically, we were from like fairly low starting points where consumer confidence was not great. Savings rates were elevated. The consumer has been deleveraging for an extended period of time. So it gives a little bit more resilience in the face of a shock, or less of a need to reset lower if you're already on that lower starting point. And secondly, I think part of the story is, we can talk about tariffs, about Doge, like trying to go after the size of the administration. But I think underlying all of that is a fiscal starting point that was maybe just a little too aggressive, too much of a deficit in the US that's being addressed by some of those measures. While if you go to, we saw it in Germany, we're seeing it in China, other parts of the world had been much more disciplined or reserved on the amount of fiscal leverage to use over past many, many years. And it gives them the opportunity, as the US is maybe ratcheting down like fiscal spending, that you'll see some other parts of the world increasing it, which won't shield the rest of the world from a potential US slowdown or recession, but it will give some offsets in terms of capacity on the fiscal side, starting point for the consumer, starting point for valuations on the market. And lastly, the market is usually dominated by multinationals, but you have two big economic poles, one being the US, the other one being China. And in a way, the further you go from North America, you start to find more balanced exposures into the revenues of many companies, either in Europe or in Japan or Asia at large, where you have a mixture of revenues from the US and from China. So if we get a scenario where the US slows down, but China stabilizes, maybe even manages to reaccelerate its economy to some extent, it will give different exposures and better ways to shield maybe a little bit of US slowdown for many companies.
So you're not saying that the US is likely to go into a recession, but things are starting to pinch and there's some signs.
Yes, it's
what signs
look, we
are you
don't have
seeing?
the crystal ball
No.
of the US is going in recession, but I think just the fact that we are talking about the potential
Yes.
in a way means quite a bit, right? From, let's just think where we were the day after the Republican win in the November election, where the world very much took the view that whatever Trump policies are going to come through is going to be great for the US and terrible for the rest of the world. I think the market is starting to digest that a little bit and saying, well, not all of that is going to be great for the US economy up front. What are we tracking to get a feel for what's happening in the US? I think
you're looking at the consumer, you're looking at...
Yeah, at the end of the day, it's a game of confidence, right?
Okay.
So we track a lot consumer confidence, I think is really important. And unfortunately, we're seeing that, we can use the word cracking at the moment.
Okay.
We look for a lot of anecdotes through our discussions with our analysts, our discussion with industry experts, discussion with management team of some of the big companies. Just as a side note, last week, myself and quite a few of my colleagues were in Boston meeting the CEOs of the majority of the largest U.S. consumer companies. And without being in a position to say too much about those meetings, but there is a clear sense of nervousness. I think a fair bit of indications that from the past, past few weeks or past month, the consumer is changing its
patterns,
propensity to spend, if we can put it this way. We don't know for sure if this will have long-lasting effect or if it's something that can bounce. But I think it is fair to say that, at least historically, those changes in confidence don't turn on a dime. So I think the risk at the moment is there's a lot of pause in decision making at the corporate level, at the consumer level, which has the potential to create a bit of an air pocket. And from that, there's the risk of, do we create a negative wealth effect? Do we create a negative confidence downward spiral? And if that takes place, it's going to be really hard to reverse, even if suddenly we were to get an administration that tries to bring more visibility to remove the uncertainty that was created. Sadly, I suspect we're at a point where the snowball is rolling. It's rolling in the wrong direction. And at some point, it will find its floor and rebound. But I don't think we are there at this moment.
So in the meantime, it requires diversification, perhaps, based on what you're saying, away from that and how you might do that. I mean, you have often been looking at Europe, and Europe has had just an absolutely momentous first quarter. Where else in the world are you looking? We'll come back to Europe, but where else are you looking to create diversification for investors?
Yeah. First, I'd like to say, as a contrarian investor, and I think that's our role, we try to pre-position ourselves on a lot of that. And that's
meaning you caught it?
We definitely benefited from this, at least change in leadership through Q1, which may or may not continue. Can't guarantee that. But the story, in my eyes, the story of the past few years is a market that got increasingly narrow. A lot of optimism, a lot of money flows went into the US, into the Magnificent Seven, into the AI dynamic. And it created pockets of very elevated expectations, elevated valuation. I think you can call it speculation in parts of the market, which, although this is what led the market for the past years, that was flashing like warning signs to me. And from a very fundamental perspective, our job is to find stocks that simply look too cheap on normalized long-term profitability outlooks. And the reality is it was increasingly challenging to find these companies within the US markets. But also over the past few years, and especially through 2024, I was looking at Europe or looking at China, emerging markets at large, with a few exceptions. And I wouldn't say it was like a walk in the park. Like the markets were not dramatically cheap, but it was more business as usual, where through the combination of our research efforts, we were trying to find companies that look mispriced and offer like good risk reward over the midterm. And I've really moved the portfolio towards Europe, towards China as the two big bets in the fund, especially in the global fund, where I have an ability to be very benchmark agnostic. And where at a time where the US became almost 70% of the MSCI ACWI, so the broadest like global index, into my global fund, we are sitting in the low 20% US exposure. And I have a lot more of that exposure to, as I said, Europe and China mostly. And it wasn't based on a view that we would have so much uncertainty from a geopolitical tariff perspective.
How could we expect this? Yes.
But it was more in a view that we can find like compellingly priced good businesses on an outlook that is maybe not the greatest or the rosiest or what's in favor at the moment, but things mean revert. And I think we have hit that point where we are getting that mean reversion, that change in leadership. So, and when it happens, it can last.
It can last. Okay, interesting. And I mean, there's real money that's been put in by countries in in Europe, meaning Germany, into things like defense and infrastructure. I mean, just walk us through that. Has that even topped, actually?
So
that was a big turning on the taps.
Right. We were talking about like the fiscal side. Obviously, given the situation in Ukraine and with what the U.S. is putting pressure on the rest of the NATO countries to do, a good part of that for Germany is going to go through defense. And this is where it's important to, there's a story of following the trends, but there's also a story of realizing when the market has appreciated those trends. I think in the case of defense, especially for the shorter cycle, like defense spending, the market is all over that. We've seen European defense stocks going up multiples from where they were. So as a contrarian investor, we had some bit of exposure to that, but this is not where I'm looking for opportunities. I think this is now well appreciated. I think at this point, it's more a view on the relative broad economic performance versus where we are today of Europe or of China relative to what we'll see in the US. And I think a lot of that goes from the ability of the consumer to spend more or spend less. And I am favoring the exposure to Europe, to China. But I appreciate that we've been seeing like a big moves from the trough. Like the inflection point has been pretty robust. It always is. I think that's why there is a case to be in strategies or try to be forward looking and pre-position ourselves for that. But I think that probably to a much lesser extent from here, but I think it will likely continue especially in the context, if what is the big story of 2025 is a US consumer that slows down, brings a slowdown or a recession in the US, I think we'll realize that the rest of the world is to some degree shielded from that, or at least on a relative perspective will be less impacted by that.
So that's interesting. And this goes to what's been priced. I just dropped the mic. What has been priced in? Because there's some obvious areas where things have been priced in, probably even to the upside in the European stocks that you're talking about. But even in terms of pricing some of the more negative things, there are some obvious things which you would be on top of, but there are a lot of things that I think we can't see. There's sort of the next, it's not a shoe to drop, but maybe the next opportunity.
Right.
Walk us through that. You mentioned that before.
Yeah. One thing I'm asked a lot is, as a contrarian investor trying to usually zig when the markets zag,
right,
am I at a point where are we starting to sell Europe, to sell China, to come back in the US? I think it's important keep in.
Are you?
I am at a very small extent.
Okay.
Trying to reduce the size of the relative positioning we've taken. But the portfolio, especially the global portfolio, is still very, very overweight the rest of the world, underweight the US. And the thinking there is, yes, we've seen a pretty big move. But I don't think we're anywhere at the point where looking at two similar companies, a US listed company would scream as being cheaper on lower expectations. So I think it talks to the extent that, in my opinion, the market sort of inflated the US market and deflated the rest. That even after what seems like a pretty big move to many, let's step back a little bit and look where we are. We're still at a point today where valuations are cheaper, not as much cheaper, but still cheaper on the markets abroad. Yep. Cheaper than historical averages, while the US is still more expensive than historical averages. We're still at a point where earnings growth are more robust for US companies than they are for the rest of the world. We're still at a point where margins versus sort of mid-cycle trajectory are more elevated in the US versus the rest of the world. And I think we're still at a point where the majority of investors still have the majority of their portfolios exposed to the US, and we're starting to see early signs of maybe a bit of repatriation of capital home, either here in Canada, but I think we're starting to see early signs of that taking place globally. So although I'm inclined to maybe no longer have like a 40 or 50% underweight to the US and start closing this gap a little bit, still sticking where the portfolio is.
So what does that say about things being priced in? I mean, have things, let's talk a little bit about that, where you see things that are being priced in and appreciated.
Yeah, I think we're again, same thematic, but I think we're in the early days of the market appreciating that. But I think if we focus on the US first, I think the big question is, to what extent are we going to see a slowdown from a consumer that may pause its more discretionary purchase decision? To what extent have we seen the impact of a lot of large companies simply not knowing like where to put the incremental growth project at this point, given all of this uncertainty? Even if they were to know that maybe given the tariffs, it makes sense to bring manufacturing home, I think the majority of corporate America CEOs are not in a position to take a 20 or 30-year investment decision of building capacity based on tariffs that could go away next week, next quarter, or 4 years from now with the new administration. So I think we're seeing a general pause at the moment. Okay. And I think it's starting to be somewhat appreciated. People are starting to talk about it, to realize that's the case. Are we at a point where this is reflected into earnings estimates from most companies? I suspect this is not the case yet. So back to my point where it will eventually create opportunities, but I suspect we are still early on that. I think you need to see a little bit more of that slowdown, or call it even that pain, materializing into financial results before simply jumping in eyes closed and hoping that we get clarity, we get visibility, maybe like towards this fall, this winter, as we head into midterm election 18 months from now. But
do you think it's similar for Canada? Canada is very exposed, obviously, and we're sort of on the cusp of tariffs as we're talking right now, so we don't know. But Is there room eventually to have a similar thesis about Canada?
I think so. There's two differences, in my opinion, when looking sort of outside of the United States, either to Canada, Asia, or Europe. Is first, we are sadly much more dependent on the US as a trade partner. Um, Look, I still believe that there is a likely scenario where Canada, potentially Mexico, will be to some extent less impacted by or subject to less significant tariffs. But at the moment, the uncertainty is just as great, and we are much more dependent on it. As opposed to you go to Europe, and then it's a mixture of US and China exposure, and then you move to Asia, and it becomes less US exposure, much more China exposure. So there's that pretty fundamental like difference. The other one that we need to keep in mind, I was talking earlier about a lot of that is driven by the consumer, the ability to spend, which has a lot to do with sort of individual balance sheets and savings
Yes.
rate. And while you go to China or you go to most of Europe, generally speaking, it's a story of higher savings rates, deleveraging for now, like an extended period of time. That gives the consumer a little bit more flexibility or more room to absorb like negative shocks. I think the sad reality is in Canada, our consumer has been levering up, is,
Right.
if anything, maybe a little bit overextended right now. So if we get a negative shock, consumer will have much less ability to stomach it. So as a result, I do have some limited exposure to Canada in the global portfolio, but I favor the rest of the world at this stage.
As a contrarian investor, where do you foresee most opportunities on a geographical standpoint at this moment? So you've mentioned a couple of areas of the world, but if you had to pick one.
If I have to pick one, I'll pick China at this point. This might sound very out of consensus. I think the view is very much the US is ultimately going after China from a tariffs perspective. I would have said Europe not long ago, by the way. But I think we've seen a pretty sharp change of expectations, rebound in the European market. We've seen some of it in China to a lesser extent. I think the consumer from government measures is potentially starting to emerge here with better confidence. And maybe the biggest point is this is not a new story. Literally since the first Trump administration, the first round of tariffs, every US or multinational that sources from China has been working, and they had almost 10 years now to work on moving supply chains away from China, in the vast majority of cases, to Southeast Asia, countries like Vietnam or Thailand, or to Mexico, or to Turkey or North Africa. The point is, a lot of the easy exports out of China to the US have already moved. And what is left today is either exports or goods produced where basically nowhere else in the world are we able to produce that quality at that price, or a portion of their exports, which is increasingly in areas where maybe hard to accept for some of us here, but where China is simply now like the world leader in, think of like electric vehicles, like batteries.
Exactly.
There's a growing number of areas where it is just very difficult to move away from that China reliance. So I think the impact of the tariffs might be less than the market fears on that country.
Okay. Oh, that's really interesting, the impact of it. Let's talk a little bit about the AI story, which is sort of a theme globally, but as you see it in China, perhaps, maybe also in Europe. But do you see that as sort of themes go to invest? Is that of interest?
I know there's been a little bit of that thematic over past few months on, is China now at a point where they can have equally good, some maybe saying better or less like resource intensive AI models, and it certainly helps sentiment on the region to some extent. I don't have a strong opinion if that is the case or not. I think there's certainly an element of them managing to do more with less, given all the export restrictions on semiconductors or like the latest technology of GPUs, etc. I suspect the US is still comfortably in the lead on the best AI models. But I think the question it brought, which to me is even more important, is which geography has the best technology. I think ultimately there is a little bit of a risk that the basic needs of it will get commoditized. Maybe the leading edge, like someone will have an edge over someone else, but it's probably not where most of the application demand will come from. But I think the more important story is, are we starting to realize that the exponential increase in compute capacity that has been required to fuel better and better models, mostly from like the Magnificent Seven companies driving those, are we starting to plateau on that? Are we starting to reach a point where the models are good enough and it becomes more about, let's try to make them cheaper so that we can roll out like loads of applications using it
on top of them,
as opposed to having like a next model that is going to be like 10x better than the prior one? Because I don't know, just as a consumer of AI, this is not work related at all, but we're already at pretty phenomenal capabilities today. It doesn't need to be like multiples better. So look, I think the jury is still out, but again, the fact that we are asking the question from a starting point that was seen as like a bulletproof trade for the next many years is creating uncertainty. And if you start to create uncertainty around the amount of hardware required to power this AI revolution, which we will get, given the amount of market cap where expectations are, it certainly has the risk of throwing some cold water on what was a very consensus exposure by many investors.
So it brings you back to sort of a leadership question at this point. As we close out, I wonder if you'll just take us to the diversification opportunities that your fund provides at a moment of what you just talked about, leadership, but also where we all are in sort of our cycles within economic cycles within here.
Yeah, I think the case is becoming more clear, right? I think more and more investors are looking at a portfolio, looking at the exposure they add to the US, but specifically like tech exposure within that. Now that there's questions emerging on it, maybe to look overseas starts to make more sense. As we discussed, if you get an inflection point on leadership, obviously a more contrarian approach is usually what will guide you through that a little bit better. So yes, I think this is a kind of environment where I'm trying to bring that diversification, not only in geographic exposure, but style exposures as well. If I can take a moment to maybe highlight, like I think we are doing it relatively well at the moment, but we've done it relatively well in the aftermath of COVID. We've done it relatively well in the aftermath of Brexit. If we go back more years ago, we've done it relatively well in the aftermath of like the inflation scare of 2022. So I think it is a reminder, and that's why I try to use those opportunities where things change to remind people that to chase it at the moment when you realize that things are changing, it is extremely difficult to do it quickly enough, especially through your clients' portfolios. And if you have an element of contrarian, differentiated exposure into your portfolios, I think this is why I'm trying to play a role, to provide some of that diversification at times where it's really needed. And usually it's needed at points where people forget that it is.
Right, like right now, everyone's sort of wishing that they had done it before. Patrice Quirion, fantastic to get an update from you and just to get sort of your views on the world and where we're sitting in some of these different markets. Thanks for joining us.
Pleasure.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.